Welcome to another deep dive. Today we're going to be cracking open Trade Like a Stock Market Wizard by Mark Minervini to explore the strategies and principles behind super performance stock trading.
Such a great book. You're going to love this one. It's packed with actionable insights, and what's particularly refreshing is how Minervini grounds his approach in his own personal journey.
Yeah, his story makes it so relatable, right? He didn't start off as some kind of all-knowing guru.
Exactly. He's very open about sharing his early struggles and losses and how he evolved his strategy through, meticulous research, hands-on experience.
His dedication to learning is inspiring. He spent countless hours reading books, photocopying materials, even creating stock charts by hand.
Imagine that. Before the days of, fancy trading software, talk about commitment.
It really highlights that achieving super performance, like mastering any profession, requires a solid strategy and a relentless pursuit of knowledge.
Absolutely. And speaking of, common misconceptions, Minervini tackles the age-old myth that it's different this time when it comes to the market.
It's so tempting to believe that
Right.
every bull market feels unique, like the rules don't apply anymore.
But Minervini debunks this myth very effectively by highlighting the timeless nature of human emotions.
Yeah.
Greed and fear that drive market cycles. Those emotions have been influencing markets forever.
Leading to those predictable patterns of booms and busts.
Exactly.
And here's where it gets interesting. Minervini says that individual investors actually have an advantage over large institutions.
Right. That seems counterintuitive at first.
It does.
But think about it. Institutions are often bogged down by, bureaucracy and the sheer size of their portfolios.
They just can't move as quickly.
Right. They lack the agility to react quickly.
So you're saying that as individual investors, we actually have the flexibility to seize opportunities that those larger players might miss.
Precisely. You can react swiftly to market changes and, capitalize on those fleeting moments of market inefficiency.
That's encouraging. So how does Minervini translate these insights into an actionable strategy?
Well, he introduces this concept of SEPA, or specific entry point analysis. It's a blend of fundamental and technical analysis designed to pinpoint those high probability trades.
Okay, let's break down SEPA. He says the four key elements are earnings and sales growth, strong catalysts that are driving institutional interest, identifying the company's stage in the growth cycle, and finding those optimal entry points.
Right. A lot to unpack there.
It is.
Minervini emphasizes that strong earnings and sales growth are really foundational. But it's not just about the raw numbers themselves. It's about understanding what's actually driving that growth.
Like, is there a compelling story behind those numbers, not just impressive financials?
Exactly. Are those earnings sustainable? What's driving that institutional interest? These are the questions you need to be asking.
Makes sense. And here's where Minervini kind of challenges another widely held belief, buying low and selling high.
Yeah, he argues that fixating solely on a stock's current price can be misleading. Instead, you should prioritize growth potential.
He uses a really fascinating example of Yahoo. Back in 1997, trading at 938 times earnings. Most investors would have run for the hills at that valuation.
For sure. But Minervini recognized that, market perception and growth potential can sometimes overshadow those traditional valuation metrics.
So in Yahoo's case, the market was basically betting on its future dominance in the internet.
Exactly. And that bet paid off big time. Yahoo shares surged an unbelievable 800% in just 29 months.
That's incredible. So understanding market sentiment and growth potential can lead to extraordinary returns.
Absolutely.
Another pillar of Minervini's approach is trading with the prevailing trend.
Right. You don't want to fight the market. You want to ride the wave.
He advocates for entering trades during what he calls a stage 2 uptrend.
Exactly. This is a phase characterized by increasing price momentum and volume, which signals really strong buying support. He actually uses this great analogy, tennis ball action.
I love that. So how does that translate to, stock market behavior?
Okay, so imagine a tennis ball bouncing back really quickly after it hits the ground.
Hmm.
Similarly, a stock that exhibits this tennis ball action is one that bounces back really quickly after a pullback.
Okay, so it's that resilience. It's showing that the stock is really in demand.
Exactly. It's a healthy uptrend, and you want to be on the right side of that momentum.
Now, while Minervini emphasizes, growth potential and technical analysis, he doesn't dismiss the importance of fundamentals.
Right. He advocates for a deep dive into key metrics like earnings growth, sales, acceleration, margin expansion, even inventory trends.
So you're not just chasing momentum, you're looking for companies with solid underlying businesses.
Absolutely. And he stresses the importance of understanding earnings quality. You want to avoid companies that have manipulated or unsustainable earnings.
It's not just earnings growth, it's the quality and sustainability of those earnings. Now, this next principle is super interesting, following the leaders.
Minervini has a keen eye for spotting market trends, and he argues that leading stocks are like canaries in a coal mine. They signal market turning points.
So these are the stocks that are breaking out to new highs, even while the overall market might be lagging.
Exactly. They're the ones often breaking into new high ground before the broader market indices.
They exhibit relative strength, showing they're outperforming the broader market.
Exactly. And Minervini also emphasizes the importance of charting for success.
So you're using charts to visualize price action and identify those optimal entry points.
Exactly. Charting for Minervini is not about predicting the future, but rather it's a tool to identify trends, consolidation periods, and those ideal entry points. He's a big fan of what's called the volatility contraction pattern, or VCP.
Can you break that down for us? What exactly is a VCP?
Okay, so a VCP is basically a pattern on a stock chart that indicates a decrease in that price volatility over time. That often forms this kind of wedge-like shape.
So the price swings are getting smaller.
Exactly, like a spring being compressed, ready to release all that pent-up energy.
I like that. But Minervini also gives a warning about deep correction patterns.
Yes. He advises against buying stocks that have fallen, 50 to 60% from their highs.
Yeah.
Because these deep corrections often signal deeper issues. They have a higher chance of failure.
Okay, so not all dips are buying opportunities. Now let's talk about risk management.
Minervini is adamant that you need to manage risk to achieve consistent returns. And he introduces this really interesting concept called the loss adjustment exercise.
So what is the loss adjustment exercise?
It's a thought experiment where you analyze the impact of limiting your losses on each trade, typically to 7–10%. So you're basically seeing how different loss scenarios affect your overall portfolio.
Interesting. So you're running simulations.
Exactly. Minervini even shares his own experience in the U.S. Investing Championship, where at one point he was actually trailing his competitors.
Wow, so how did risk management play a role in his ultimate win?
He stuck to his plan. He was meticulously cutting losses, which allowed him to stay in the game and ultimately emerge as the champion.
So that's a testament to sticking to a well-defined risk management plan. Finally, Minervini talks about developing those winning habits that really set super performers apart.
It's not just about having a great strategy. It's about having the discipline to execute it consistently.
Right, so it's about building habits that help you stay focused, avoid emotional decisions.
Exactly. He encourages developing habits like pre-planning your exit strategies before entering a trade. He compares it to a pilot using a pre-flight checklist to manage risk.
So you're thinking ahead, having a plan.
Precisely.
Oh,
And he also stresses the importance of having that well-defined trading plan, outlining your entry and exit points, your risk management parameters, your position sizing guidelines.
like having a roadmap for your trading journey.
Exactly.
Now, before we dive into the next part of our deep dive, I want to ask you what's resonating with you so far.
Well, one thing that really struck me is how Minervini breaks down stocks into different categories.
Yep.
Each with its own characteristics and behaviors.
Yeah, that makes sense, right? You wouldn't approach a slow-growing blue-chip company the same way you'd approach a, high-flying tech startup. So what are some of those key distinctions?
Well, he highlights, these different categories: market leaders, institutional favorites, turnarounds, and new issues. Each plays a different role in the market and requires a tailored approach.
Let's start with market leaders. These are the companies that are dominating their industries, setting the pace for innovation and growth.
Exactly. Think of companies like Tesla or Amazon. They often have those, groundbreaking products or services that disrupt entire industries. These are the companies that attract, huge amounts of institutional investment.
Right, which drives their stock prices higher. Minervini gives some great examples of past market leaders like Amgen and Cisco Systems back during the tech boom of the 90s.
Right, and these companies saw explosive growth, even though their valuations might have seemed really high at the time.
Yeah, so you're looking beyond the current numbers and focusing on that long-term growth trajectory.
Exactly. Now, what about institutional favorites? These are more like the blue chip companies, often with those long track records of consistent earnings and dividend growth.
Yeah, think of companies like Coca-Cola or Johnson & Johnson. They're seen as safe havens, especially in times of market uncertainty.
Exactly. They appeal to, conservative institutional investors who prioritize stability and steady returns. However, Minervini cautions against expecting superperformance from these stocks.
So while they provide a solid base for a portfolio, they're not necessarily going to give you those, explosive returns that we're talking about.
Right, they just don't have that potential.
Their size and mature nature kind of limits their potential for explosive growth. Now, turnarounds are really interesting. These are the companies that have faced challenges, maybe even been on the brink of collapse, but they're showing signs of recovery.
Yeah, a turnaround situation can be risky, but it also has that tremendous upside potential if you can identify, the early signals.
Minervini actually highlights Apple as a great example. Back in the late 90s, Apple was struggling. Their stock price had plummeted over 80%, and people were writing them off.
It was a tough time for Apple. But then the introduction of the iPod in 2001, followed by the launch of iTunes. It sparked a remarkable turnaround.
The company reinvented itself, tapping into new markets, and the stock price responded accordingly.
It's a powerful example of how a company can overcome adversity and come out even stronger. Now, finally, let's touch on new issues. These are the companies that have recently gone public.
IPOs. They can be alluring, right? Because they often represent emerging industries or disruptive technologies.
Right. There's that potential for those early investors to get in on the ground floor of the next big thing. But Minervini cautions against jumping in too early, because you know that hype surrounding an IPO can lead to inflated valuations and volatile price swings.
So you're not rushing in, you're waiting for things to settle down.
Exactly. He emphasizes the importance of waiting for that primary base to form before considering an investment in a new issue.
What exactly is a primary base?
So a primary base is essentially the first period of consolidation and price stability after that company goes public. It signals that that initial frenzy has kind of subsided.
Okay, so the stock is finding its footing. So you're looking for that combination of a solid foundation and evidence of market acceptance before jumping into a new issue.
Exactly. Now, shifting gears a little bit, let's talk about earnings quality. This is where your analytical skills really come in.
It's about understanding what's driving those earnings and whether they are sustainable.
Exactly. Minervini cautions against companies that manipulate earnings through, accounting gimmicks or rely heavily on one-time gains.
So what are some red flags?
Red flags. Okay, well, things like selling assets to generate non-recurring gains, using one-time charges to mask weak operating results, or even aggressively managing inventory to create, the illusion of strong sales.
Wow.
It takes a keen eye to spot these tricks.
It does.
Minervini stresses that you really need to scrutinize those earnings reports. Go beyond just the headlines. You have to dig into the footnotes and the management's discussion.
Really get under the hood and see what's driving the numbers.
Exactly. And you want to make sure that earnings growth is sustainable. Are those gains driven by, organic sales growth, expanding margins, new product innovation, or are they just reliant on accounting maneuvers and temporary boosts?
Right. He also emphasizes understanding inventory trends. Why is that so important?
Well, inventory represents a significant investment for most companies. If inventory is piling up faster than sales are coming in, it can be a sign of trouble.
Okay. It could signal a slowdown in demand.
Exactly. Potentially pricing pressure and ultimately a hit to earnings.
So it's a balancing act. You want to see inventory growing, but not out of control.
Right. A healthy inventory turnover rate indicates that the company is managing its operations efficiently.
Okay. Minervini also cautions against companies that are overly reliant on debt to fuel their growth.
Excessive debt can be a major red flag. While some debt can be, healthy, too much can limit flexibility and increase risk.
Right. Making the company vulnerable to economic downturns or changes in interest rates.
Exactly. So you're looking for companies that are managing their debt prudently and using it to support sustainable growth, not to, mask underlying problems.
Right. Now let's go back to one of Minervini's core principles, following the leaders. He argues that leading stocks are often early indicators of market trends.
Right. So instead of trying to predict the market's every move, you're watching these stocks for clues about where the market might be heading.
These are the stocks that are breaking out to new highs, even while the overall market might be lagging.
Exactly. They're often the first to break into new high ground.
Exhibiting that relative strength.
Right. And Minervini cautions against being swayed by, news headlines or the opinions of the crowd. He says focus on the price action.
Trust the signals.
Exactly. Now, this next principle might seem a little counterintuitive. Minervini actually suggests that you shouldn't be afraid to buy stocks that are making new highs.
That goes against the grain for a lot of investors. They want to find bargains. They want to buy low.
I know, right. But Minervini argues that stocks making new highs are often doing so for a reason.
They have strong momentum.
Right. They're attracting institutional buying pressure.
So you're saying it's a sign of confidence in the company's future.
Exactly. He points out that, a lot of those big winning stocks, they continued to make new highs throughout their whole bull run.
So trying to time the market perfectly and wait for a pullback could mean missing out.
Exactly. It's about understanding that price often reflects the underlying fundamentals and the sentiment towards that stock. If a stock is consistently making new highs, it's a signal of strength.
Of course, this doesn't mean just blindly chasing any stock that's going up.
Of course not. You still need to apply your analysis and make sure the company has, solid fundamentals, a compelling growth story, and those technical signals of a healthy uptrend.
Right. Now let's delve into Minervini's approach to using charts. He's a big believer in the power of visual analysis.
Charts help you understand price trends and identify potential setups.
So you're not just relying on numbers and ratios, you're looking at that visual representation.
Exactly. Minervini emphasizes that charting isn't about predicting the future. It's about identifying patterns and trends that suggest a higher probability of success.
Right. He's a big fan of the volatility contraction pattern, or VCP.
Yes.
We touched on it a bit earlier. Can you remind us what makes this pattern so important?
So a VCP is a pattern on a stock chart that shows that decreasing price volatility over time. It often forms this wedge-like shape, suggesting that selling pressure is waning.
It's like the stock is coiling up before making a big move.
Yeah.
Now, he also cautions against chasing stocks that have experienced those deep corrections or that are showing signs of, excessive volatility.
Right. Because those patterns often signal, underlying issues.
You're looking for the stocks that are exhibiting controlled volatility. Now, beyond just the technical aspects of trading, Minervini gets into the psychology of trading.
That's so important. The psychological aspect is often overlooked, but it's absolutely crucial for long-term success.
So developing discipline habits and managing your emotions.
Exactly.
Right.
You don't want to make impulsive decisions based on fear or greed.
It's about having that mental fortitude.
He talks about pre-planning your exit strategies,
Yeah.
Before even entering a trade.
So thinking ahead, having a plan for each outcome.
Exactly. And he also stresses the importance of managing your position size. Making sure you're not overexposed to any one stock or sector.
Right. Diversification, it's about spreading your risk.
Exactly. Now let's talk about risk management. Minervini talks about an exercise called the loss adjustment exercise.
We touched on that briefly earlier. How can this exercise help investors manage risk?
Well, it helps you understand the real impact of losses on your returns. Basically, you analyze what would happen if you capped your losses on each trade, say at 7 to 10%.
So you're kind of running different scenarios.
Exactly.
Yeah.
And it's amazing how even just a small reduction in your losses can really improve your overall performance.
Minervini talks about his own experience in the U.S. Investing Championship, where at one point he was actually trailing his competitors.
Yeah, but he stuck to his risk management plan. He was meticulous about cutting those losses.
And that discipline helped him stay in the game.
Exactly. And he ultimately emerged as the champion.
It's a good reminder that it's not about always being right, but about protecting yourself from those big losses.
Absolutely. Now, along with risk management, Minervini emphasizes developing winning habits that separate the super performers.
So it's not just about the strategy itself, but the mindset and discipline to execute it consistently.
Exactly. He encourages investors to develop, pre-trade routines, kind of like a pilot's pre-flight checklist.
Okay. To make sure they're making, rational decisions.
Exactly.
Yeah.
Decisions based on analysis, not emotions.
Sticking to the plan. And he also talks about having a well-defined trading plan.
Oh, that's crucial. Outlining your entry and exit points, risk management parameters, position sizing guidelines.
Like a roadmap for your trading.
Exactly. Now, one thing that I might surprise some listeners is Minervini's perspective on those professional money managers.
People tend to think they have a secret edge, some insider knowledge.
Right. But Minervini argues that individual investors actually have some significant advantages over those institutions.
Really? That's interesting. What are those advantages?
Well, for one, institutions are often bogged down by their size. They just can't move as quickly as individuals.
Oh, not as nimble.
Right. And they might have restrictions on the types of investments they can make, too.
So individual investors have more flexibility to seize those opportunities.
It's exactly. Plus, individuals aren't subject to the same performance pressures that often push those managers to make, short-sighted decisions.
They can take a longer-term perspective.
Exactly. Now let's talk about one of Minervini's most valuable concepts, Understanding industry group cycles.
Okay.
He emphasizes the importance of identifying those sectors that are in strong secular growth trends and focusing your research on the leading companies within those groups.
So basically riding the waves of those growing industries.
Exactly. He also encourages investors to keep an eye out for, emerging trends and innovations that could disrupt existing industries.
Looking for those future market leaders?
Exactly.
Yep.
Like U.S. Surgical Stopper. They pioneered the surgical staple, which led to the development of laparoscopic surgery.
Wow, creating a whole new market within the medical device industry.
It's a perfect example of how one innovation can transform an entire industry and create those amazing opportunities for investors who can spot those shifts early on.
It makes me think of how the internet revolutionized everything, leading to companies like Amazon, Google, Facebook.
Exactly. Those were once small startups, but they capitalized on a game-changing technology.
It's about staying curious, staying informed, right?
Absolutely. Now, as we wrap up our deep dive into Trade Like a Stock Market Wizard, I want to highlight one of Minervini's most powerful messages.
Okay.
He emphasizes that anyone can learn these principles of super performance and achieve their financial goals.
It's a very empowering message.
It is. Success in the market is not limited to a select few.
It's accessible to anyone willing to put in the work.
He encourages us to embrace the journey, to view mistakes as learning opportunities, and to never stop learning.
Great advice. So as you continue on your investing journey, remember to stay curious, stay disciplined, and stay focused on your goals.
And don't underestimate the power of a well-defined strategy, a commitment to risk management, and the courage to follow your convictions. Thank you so much for joining us on this deep dive into Trade Like a Stock Market Wizard. We hope you found it valuable. Remember, the path to success in the market is a marathon, not a sprint, so stay patient, stay persistent, and never stop learning. Until next time, happy trading!